Chapter 1, Review Questions. One critical thing to know about accounting is that what you learn in the early chapters carries over to all future chapters. For example, the accounting equation will be used in every chapter. So in other words, accounting builds on itself. If you forget about the difference between assets and liabilities in future chapters, you will struggle. If you forget about the difference between revenues and expenses, you'll be confused in future chapters. So I've created these review questions to help you learn and practice the most critical and important parts of accounting. Now most of the questions should be easy, like this one. Hopefully by now you realize that any account that has payable in its name is a liability. These review questions would be fantastic questions to put on flashcards. Carry them around, and whenever you have a minute or two, instead of checking your phone to see your latest text, do a couple of flashcards. I've done 90% of the work for you. I've figured out what the most important things are, I've turned them into questions, and I've put them all in one place here in my accounting lab. I cruised through college and got a 4.0 GPA not because I was smarter than my classmates, but because I put critical information on flashcards and practiced them whenever I had a few spare minutes. So to encourage you to continually practice these, a handful of these review questions will appear randomly on future tests and practice tests. So please study these frequently so they become easy for you. Alright, hopefully this first question was easy. Let's try the next one. Accounts receivable is what type of account? Hopefully this one's easy too. Since we're going to receive something in the future, something of value, this is an asset. Next question. Cash is what type of account? I told you these would mostly be easy. Cash, of course, is an asset. It's everyone's favorite asset. A company's assets, liabilities, and owner's equity as of a specific date. Now this one's a little bit more challenging. Which of the financial statements shows assets, liabilities, and owner's equity? Notice that's the accounting equation. As of a specific date. Well, that's the balance sheet. The balance sheet is based on the accounting equation and shows the balances of those accounts on a single day. Now, some of these questions will have things you've never heard of. You might not have heard of a ledger yet, or a worksheet, or a trial balance. That's because these review questions will also be used in my other classes where they know those things. So if there's a term that you don't understand, that's fine. Just don't choose that one. What do you call a summary of a company's revenues and expenses and net income or net loss for a specific time period? So in other words, which financial statement shows revenues, expenses, and net income? Well, hopefully you know that that's the income statement, also called profit and loss. Now, what's the correct order in which to create the three main financial statements? So which one do we create first? It's the income statement, so it's either A or B. Which one comes next? Statement of owner's equity, and then the balance sheet is last. The reason the income statement is done first is you need to calculate net income for the statement of owner's equity, and the reason you do the statement of owner's equity before the balance sheet is you need the ending capital from the statement of owner's equity to go on the balance sheet. And if you forgot the three financial statements and their formulas, here it is. We do the income statement first, statement of owner's equity, and then the balance sheet. Next one. What do you call a summary of a company's revenues, expenses, and net income or net loss for a specific time period? Now you might be thinking, well, we just had this question. It's the income statement. So let's look at our list of answers. Is the income statement on there? Nope. But remember, it's also called the P&L, also known as a profit and loss. So the reason I'm making sure that you know these different terminologies for the same thing is, let's say you go in for an interview and you hear them ask you, or one of the questions they ask you about is a P&L. Well, if you're only familiar with the income statement and you all of a sudden hear P&L, you say, I don't know what that is. Where actually you do know what it is, you just didn't know it by its separate name. So that's why you need to know the different things, or the different names for these different things. Now this is easy. An income statement is also known as what? We just had this one, P&L, also called profit and loss. I told you a lot of these would be easy. To find out if a company is making a profit and how it made the profit, you would look on what? Which of these would you look on? You would look on the income statement, because that's the only one that has net income. And notice it says how it made the profit. Now some people might say, well, the net income is on a statement of owner's equity. True, but the statement of owner's equity does not show you how they made the net income. The income statement would show you the revenues, which is how a company made their profit. So that's income statement. What do you call a summary of the changes in an owner's capital account during a specific time? So which of these three statements shows what happened to capital over a period of time? It's a statement of owner's equity. The balance sheet has the ending capital, but it does not show you what the beginning capital was, so that would not be the right answer. Statement of owner's equity. Which accounts directly affect owner's equity, also known as capital? Well, this is a really critical one to understand. So do you remember the four things that affect capital? Well, revenues make capital go up. Expenses make capital go down. Owner's investments make capital go up. That's like when the owner invests cash into her company, so cash goes up and then equity goes up. And then draws make capital go down. So this is the correct answer. What's the formula for the accounting equation? Well, if you guys screw this up at this time, I might be forced to retire. So what's the accounting equation? Assets equals liabilities plus owner's equity. That's the traditional one. What's the formula for the balance sheet? Here's a balance sheet. Assets equals liabilities plus capital, also known as equity. Assets equals liabilities, here it is, plus equity. Don't grab the one that says minus owner's equity. Don't be in a hurry, like I almost did. All right, how do withdrawals, affect owner's equity? In other words, capital. They decrease it. When the owner takes money out of the business, cash goes down and then the equity also goes down. How do expenses affect owner's equity? They also decrease it. What's the formula for the income statement? Well, hopefully you don't need this little cheat sheet here. Revenues minus expenses equals net income. How do owner investments affect capital? Well, remember, if the owner invests cash into her business, cash goes up and then equity goes up. If equity did not go up, what else would go up? Would liabilities go up? No. What's the formula for net income? Well, we just went over this. Revenue minus expense equals net income. Here it is. Revenue minus expense equals net income. What is the formula to determine if a company made a profit? You might say, well, wasn't that the same as the last question? Well, the last question was, what's the formula for determining net income? So this is actually asking you if you know that net income and profit are the same thing. So it's still revenue minus expense equals net income, also called profit. How do revenues affect owner's equity? So remember, when we sell something, we have to record revenue, and that increases equity. That's a good thing. What's the formula for this statement of owner's equity? It's bind with an E, beginning capital plus investments, also called owner contributions, plus net income minus draw equals ending capital. So beginning capital plus investments plus net income minus draws. Don't choose this one because it says plus draws. A liability, what do you call a liability that's usually due within 30 days? That's accounts payable. What do you call the right to receive cash in the future from customers to whom the business has sold goods or for whom the business has performed services? So someone comes into your store and they buy a product or a service and they promise to pay you later. You need to keep a list of how much they owe you and who owes you that. So what account is that? That's accounts receivable, because you're hoping to receive that payment from the customer in the future, and that's an asset. This account contains owner investments. Notice it says plus. So owner investments makes this account increase. Revenues makes this account increase. Expenses make this account decrease. And draws make this account decrease. That sounds like capital, which is the same as the equity. So capital is the name of the equity account. Equity is a classification. Capital is the name of the account. So basically, this is asking you, another way of asking you, do you know the 4 things that affect capital? The portion of the assets that the owner owns. So remember the accounting equation, assets equals liabilities plus owner's equity. It's just basically showing you on the left side what the business owns, and on the right side it's showing you who owns it. So owner's equity is the amount of the assets that the owners own, and then the liabilities are the amount of the assets that others own, like the bank. So the portion of the assets that the owner owns, that's equity. Now, what do you call spending money or promising to pay later for business-related items that do not provide a future benefit? So this is like you get a phone bill for your telephone for the business. Well, that's an expense. Remember, the difference between an expense and an asset is an asset has a future value. An expense, like your phone bill, that's you're paying for something that's already used up. Debt. I hope everyone gets this one right. Debt is just another way of saying liability. Something you owe. Debt is bad for the most part. The portion of the assets that others own. So this company has $400,000 of assets. How much do others own, like the bank? $100,000. I'm not sure why my numbers got chopped off here. Sorry about that. So liability is another way of saying the portion of the assets that others own. 2 more to go. Profit is also known as net income. And lastly, what do you call the amount earned by performing services for customers or selling goods to customers? So once you sell a service or a good, now remember goods just means products. Goods is an old way of saying products. So another way to say this is amount earned by performing services for customers or selling products to customers. So when you sell something, what do you record? Revenue. Even if you don't get cash for it yet, you still record revenue. So when you sell something, you're either going to record cash or you're going to record accounts receivable. And then of course you record revenue. So that's it for Chapter 1's review questions. I believe Chapter 1 has the most review questions. Future chapters will likely, well, except for Chapter 2, will likely have fewer review questions. So make sure you study these and you get to know them real well. If you have any questions about these, always send me an email on Canvas.